So, good evening. So we had started something on the M&M. So we can now do some questions. On that element of the Modigliani and the Miller. So we noted something about the Hamad model. So what we shall do is to do a question on that part so that we establish how to obtain the optimal capital structure. So from what we summarized in the last class, we said that the optimal capital structure is where the value is meant to be maximum and WSC is meant to be minimum. Then also in the process, you are able to see how to compute the beta factor of equity for the unlevered and also for the levered firm. So we discussed the model which you can be able to apply. So you are to look for a question. It was meant to be for which sitting? Do we specify a question on that? So the question you are to deal with should be for the sitting of November 2019. November 2019. Question number 2, part B. November 2019. Question number 2, part B. We can now check the question. November 2019. Question number 2. So we check November 2019, question 2B at that level. We can be able to begin that question number 2, part B. So we check the question for November 2019, question number 2, part B. So that question reads that the finance director wishes to determine the company's optimal capital structure. It is on page 23. When we check on that page 23, you'll see the question number 2, part B. So the cost of debt varies. The cost of the debt varies according to the level of gearing of the company as follows. So you are given percentage of the debt, also the pre-tax cost of the debt. So in the additional information, note number 1, they said that the company's ungeared equity beta was given as 0.85. It was given as 0.85. Then you are also given the issues to do with the risk-free rate, which is 6%. Then also market return, which is 14%. They also gave you the corporate tax rate, which is 30%. So now required, advise the company on the optimal capital, on the optimal weighted average cost of capital. So they want you to advise on the optimal weighted average cost of capital. So the optimal WSC is where it will be minimum. So in that case, there are 3 models which will be able to apply. The first one is the Hamad model to get the beta factor of equity of the levered. Then we use CAPM to get the cost of equity for the levered firm. And now we apply the capital structure to compute the WSC. So we shall simplify the question in this manner. We shall be able to simplify it in this manner. So we shall be having the column for equity. We shall have the column for equity. We shall come up with the column for the equity. Then also the column for the debt. Like that. Then once we have done that, we now apply the Hamad model to compute the beta factor of equity for the levered farm. So I gave you the formula. It is supposed to be given by the beta factor of equity for the unlevered farm. Then 1, we add D over E. Then 1 minus the tax rate. So that's now meant to give you beta factor of equity for the levered farm. So once we have done that, then we compute the cost of equity for the levered farm. So cost of equity for the levered farm, we use CAPM, whereby you get the risk-free rate, we add expected return for the market minus the risk-free rate, then beta factor of equity for the levered farm. Then now after that, we come up with the WSC. So WSC, we get the weight of equity, cost of equity for the levered farm. Then we also add weight of the debt, and the KD must always be after the tax. KD must always be after the tax. So we shall be able to apply that portion to see how we can come up with the optimal WSC, to come up with the optimal WSC. So I'm simplifying the question in that order so that we get the optimal WSC. So we shall simplify the information on the basis of that. So we start off with the first one. They had talked about the capital structure. Under the assumptions of the theories of the capital structure, we say that there are only two component sources of finance, equity and debt. So the first one, they have given us the debt is 10%. So if the debt is 10%, it means equity must be 90%. The two should add up to 100. So equity will be 0.9. 0.9 when the debt is 0.1. There is 10% for the debt, which means equity must be 90%. So 90% is the same as 0.9. Then 10% is the same as 0.1. So we shall be able to assess them on that portion. Then once we have done that, we now come to this point to compute the beta factor of equity of the levered farm. So beta factor of equity for unlevered is in the note number 1. The ungeared equity beta, they gave us 0.85. We have a value of 0.85. Then 1 plus the proportion of the debt is 0.1. Proportion for equity is 0.9, like that. Then we multiply by 1 minus the tax rate. So it is 1 minus 0.3. 1 minus, because the corporate tax rate is 30%. So 1 minus 0.3 is the same as 0.7. So multiplied by 0.7 at that point. Then come up with the value for that. So also round it off to 2 decimal places, because so far the one that was given was in 2 decimal places. Sorry. 0.92. So we get 0.92. So once we get that, we now come to this point, KEL. So risk-free rate was given. The risk-free rate was given in the question. So risk-free rate had been given a value in the note number 2. They gave us 6%. So it will be 6%. Then we add expected return for the market was also given in the note number 3, which is 14, also minus 6. Now the beta factor is 0.92, like that. So that we now come up with what is supposed to be the cost of equity for the Libert family. Also round it off into 2 decimal places. So when we do that, it will give us which figure? 13.36. Sorry? 13.36. 13.36, like that. So now after that, we come to this point to compute the WSEC. To compute the WSEC. Compute the WSEC. So to get our WSEC, the weight for equity, it is 0.9. The weight for equity is 0.9. So we take 0.9 multiplied by KEL. KEL is the 13.36. Then we add the weight of the debt, it is 0.1. It is 0.1 multiplied by KD. KD is the pre-tax cost of the debt. KD is meant to be the pre-tax cost of the debt. So when we multiply by KD, we have been given which figure? It is 6.0. So multiplied by 6.5, but we also multiplied by 1 minus the tax rate. We also multiply 1 minus the tax rate. So the tax rate was which value? 30%. So this one will be the same as now 0. We multiplied by 0.7, like that. We multiplied by the 0.7 at that level. So that one should give us around which figure? Sorry? 12.48. So that's now for the first one. That was for the first one. So we go to the second one. The second one, they have given us the percentage for the debt is what percent? 20%. So when the debt is 20%, that's the same as 0.2. It means equity must be 0.8, like that. So when the debt is 20%, equity must be 80%. So we also get to this point where we shall have 0.85. Then also 1, then we add 0.2 divided by 0.8. Also multiplied by 0.7. Then we come up also with the value for that. Also, you round it off into also round it off to 2 decimal places to give us which figure? 0.9. 0.99. 0.98. 998. So maybe I can just add the 8. If I round it off more, it may affect our key, but it will be 1. Maybe just for differentiation aspects, maybe I can use 0.998. So this one was 0.92. Yeah, anyway, to not make much difference, we can just apply that value so that when it comes to this point, it will be 6. Then also 14 minus 6. Then also multiplied by 0.998. And see the figure we shall be able to get at that point. So this is now giving us around which value? 13.98. Then now we also compute our WSC. So WSC, the weight for equity is 0.8. Then our KEL is 13.98. Then the weight for the debt will be 0.2. So before tax, the pre-tax cost of the debt is the same as before tax cost of the debt. It is 7.1. Also tax it by multiplying by 0.7. So that you get the WSC for that. So that we come up with the WSC for that portion. So we now go to the third one. The third one, they gave us 30%. So this one is 0.3. It means this other one is 0.7, like that. So 30%, and now the other one must be 70%. 30%, the other one should be 70%. So when it now comes to this portion, it is 0.85. Then also 1, then we add 0.3 divided by 0.7. Also multiplied by 0.7. So that we get there. So that one is giving us which figure? Sorry? 1.11. So that's what should be our KEL. $14.88. So we shall be able to get 14.88. So that we now also compute our WACC. We now also calculate our WACC, whereby it is now going to be 0.7 multiplied by 14.88, then also 0.3. So we also multiplied by, that one is 7.8. Also multiplied by 0.7. So we go to the third one, so the fourth one. So the fourth one, it is 40. So when it is 40, this is 0.4. This other one must be 0.6 like that. So we shall be having this other one should be 0.6. So we also get to that point where you take 0.85, then 1, we add 0.4 divided by 0.6, also multiplied by 0.7. So we get 1.247, which is the same as 1.2. So you can use 1.25. So that should give us now which figure? 1.6. You get exactly 16. So after that, we go to the fifth one. The fifth one, equity debt is 50%. So that will be the same as 0.5. Also 0.5. So 0.5 and also 0.5. So 1.45. So it will be 1.45. So when it comes now to this point, it will be 6. 14 minus 6, then 1.45. So that we now get the cost of equity for the third farm. The 17.6. So now this one will be 0.5 multiplied by 17.6. We also add 0.5 multiplied by 10, also multiplied by 0.7. Then we also go to the second last, the one for 60. So when it is 60, this one will be 0.6. This other one should be 0.4. Like that. So it will also be 0.85, then 1, we add 0.6 divided by 0.4, also multiplied by 0.7, also multiplied by 0.7. So that one should be which figure? So that is the 1.74. So we get to 1.74. Then we now also establish what will be our. So this will be the same as 0.4. So that cost of equity is which value? 19.92. So multiplied by 19.92. So the pre-tax was given as 12. Also multiplied by 0.7 to get the value for that. Then finally, we go to the last one. So the last one will be 0.7, which means this one is 0.3. So that we can also be able to have 0.85, 1, then we add 0.7 divided by 0.3, also multiplied by 0.7. So that now when it comes to this point, it it will be 6, then 14 minus 6. So that value I'm getting 2 points. So 2.24. Then once you have done that, we now get our WSC, which should be now 0.3. So 0.3, this other one we multiplied by which figure? Sorry. 23.92. So this one is 15, also multiplied by 0.7. So we are now to check among all of them where the WSC will be minimum. So we need now to establish where the WSC is minimum. So WSC is minimum when equity is 0.1. 0.4. Yeah, so it means it is along this range. So it was which figure? Now WSC for this one is which figure? 11.98. So we can now make a conclusion on that. We can now make a conclusion on that by summarizing that. We can summarize that. Optimal capital structure is where WSC is minimum. Optimal capital structure is where WSC is minimum, i.e., where equity is 60%, where equity is 60%, where equity is 60% and debt is 40%, where equity is 60% and the debt is 40%. Then you proceed and say that the optimal WSC is 11.98. The optimal WSC is 11.98. So that's the minimum. Yeah, so that's now how you are to go about to comment on that. So the optimal WSC is normally where WSC is minimum and the value is maximum. So now from that perspective, we shall be able to analyze it from that level. So that is now on that question. I want us to get another similar question. We also check and see how we can also be able to determine the optimal capital structure. So the next question should be, so there is another question for the sitting of, so it should be November 2018. November 2018, question number 5, part C. November 2018, question number 5, part C. We check November 2018, question 5, part C. It should be on page 36. It should be on page 36. So on page 36, we have question 5, part C. So we can go through that question 5, part C, where you are given information that Embakasi Investment Limited, contemplates to determine its optimal capital structure. It contemplates to determine its optimal capital structure, which currently consists of debt and common equity only. Then you are also given that the company does not use preference shares in its capital structure, and it does not plan to, do so in the near future. So in order to estimate how much its debt will cost at different debt levels, the company's financial controller has consulted with the investment bank, and the following information was obtained. So they gave you debt to equity ratio, then bond rating, before tax cost of the debt. Additional information, not number 1, the company will use CAPEM to estimate the cost of capital. So CAPEM is this region, this one is CAPEM, to get the cost of equity. Then, not number 2, risk-free rate of return is given as 5%. Then, market risk premium, they gave us 8%. So risk premium is this region. When you take expected return of the market minus the risk-free rate, this zone is what we refer to as the risk premium. So they have already calculated for you where they take expected return for the market minus the risk-free rate. Then they continued to give you the corporate tax rate is 13%. Then note number 5, the company uses Hammer model to determine its levered equity beta. So this is the Hammer model, how to use it to get the beta factor of equity for the levered firm. Then asset beta. Asset beta is the same as unlevered equity beta. So they have given you that figure, which is meant to be 1.20. They have given us 1.20. So required, they were asking you to calculate the optimal capital structure. Then Roman letter 2, optimal WSEC. Optimal WSEC. The only challenge in that question, unlike this other one, we have not been given these proportions. Proportions have not been given, but they have already calculated for you P over E. Debt to equity, you see what they gave us, debt to equity ratio. Like in the second one, you can see the 0.25. Are you able to see the second one is 0.25? So you will be required to work backwards so that you get these proportions. We need to work backwards so that we get those proportions. So proportions were not given. The proportions, they had not been given, but I want to use one of this one to see how it works for us. How it works for us on that level. So when you check the second one, I'm concerned about the second one because it is easier. You see that second one, debt to equity ratio, they have given us 0.25. So debt to equity ratio, they have given you 0.25. So this is what they have done. D over E has been calculated. D over E, they have calculated. So that second one, after they divided, they got what? 0.25. So 0.25 is the same as 0.25 is 2, 1, like that. It is the same as 0.25 is 2, 1. So we want to go backwards to get now the proportion of the debt and also the proportion for equity. We get the least common multiple between these two. The least common multiple between these two. So 0.25 is the least. It will go there once. It will also go there 4 times. 0.25 will go to itself once. It will go to 1 4 times. So that when you add them, they will come to 5 like that. So that debt should be 1 divided by 5. The debt will take 1 divided by the total. So 1 divided by 5 is the same as 0.1. It equals 0.2. Then also equity is going to be 4 divided by 5, which is the same as 0.8. So this is what we have here. You see this item? Yeah, just confirm. When you take 0.2 divided by 0.8, it will give us which figure. Just calculate at this point. 0.2 divided by 0.8 is giving us 0. That's what they have done. They have already calculated for you this figure. They have already calculated for you this value. So now it is now upon you to follow this to come up with the 0.2 and 0.8. You see here they gave us 0.2 and 0.8. Then they did not calculate for you, so you commute that. But now this time around, they have calculated for us this point. They have given me 0.25. So we need now to know how to go back to get this and that. So also, it is not always a must to get the least common multiple. This function is there on your calculator. We have this function on your calculator. So on your calculator, there is something of AB, then like that. There is something about AB, then C. So what do? You just take 0.25, get the answer for that on your calculator. You see 0.25 and get the answer. Then press this sign because it is there on your calculator and get the answer for that. You are getting 1:4. You will be able to get 1:4. So there is no need of you looking for the least common multiple. What you should do on your calculator, simply enter 0.25 on your calculator, get the answer, press the sign for the answer for that. Once you have pressed the sign for the answer, come and press this sign also on your calculator. It will give you this fraction. It will give you this fraction. So when you add 1 plus 4 will definitely be what? 5. So that now the proportion for the debt, it is 1/5, which is 0.2. This other one is 4/5, which is 0.8. So I hope that is clear for those who are online, because this question did not give you the proportions. Instead, they calculated for you the debt over equity. So now it is upon you to use this format to work backwards to get now the proportion for the debt and also the proportion for equity. So is it clear to everyone at that point? Yeah, someone is saying that he's getting an error. Then if you are getting an error, you have not followed the rules of your calculator. Yeah, the rules of your calculator will be that write 0.25 on your calculator, then get the answer. Press the sign for the answer. After you press the sign of the answer, now come and press this sign and get the answer, and also press the sign for the answer for that. So, is it clear at that point? Someone said it was giving them syntax error. So, are you still getting an error? Are you still getting an error? Someone has said it was getting an error. So, that's what we should do. So we shall have a short break for those who are going for the prayers. Then when we come back, now we proceed from that point. So let us have a short break from that level. So we can now check this question. So we can go through that question. So it is November 2018. This question number 5, part C. So we check now November 2018, question 5, part C. So the presentation is still the same. We shall have equity, debt, then also that portion like that. So the presentation is still the same from that level. So you can have equity, debt, then the beta factor of equity for the delivered firm, which will be given by that formula. We also have that, also that way, so that we can now come up with how to calculate the WSEC. So that we can also be able to come up with how to compute the WSEC for that. So we shall be able to start off with the first one. We shall start off with the first one. So the first one, you can see they are given you the one, so you can leave a space. There were how many? There are 5 of them. Yeah. You see, there are 5. So you can leave a space of like 6 lines. We do the workings. We can leave a space of 6 lines so that we do the workings. So the first one, we start with the bond rating A. The first one is bond rating A. So for the bond rating A, they have given you debt to equity ratio. Debt to equity ratio. So they are able to give us 0.0. So it is 0.0 So it is the same as 0.0 to 1, like that. So that ratio should be 0:1. Yeah, a figure, 0 divided by any figure, it will be 0. So that first one, it simply means that the debt is 0 when equity is 1. So there is no need, even when you go through the question, you can see before tax cost of the debt, it is 0, isn't it? So that first one, there is no debt, there is only equity. So that ratio will be 1:0. Debt is 0 and equity will be 1. So we start off at that level. So beta factor of equity of ungeared, it is there in the note number 6. Note 6, you are given asset beta or unlevered equity beta of 1.2. So this one is 1.2. This one is 1.2. Then 1 plus. So D over E is 0. They have given you that figure. It is 0. Then multiplied by 0.7, like that. So that this one will just remain which value? It will just remain 1.2. That value will just remain 1.2. So this is now 1.2 at that level. Then, once we have done that, we now come to this region. Risk-free rate. Risk-free rate is given as what figure in the note number 2? They have given us 5. Then, expected return of the market minus the risk-free rate is the same as the risk premium. So they gave you in the note number 3 a figure of 6. Then 1.2, like that, so that you get the value from it. Which figure? 14.6. So that's it, it's 14.6. So for the WSEC, the weight for equity will be 1 multiplied by 14.6. Like that. Then the weight for the debt, it is 0. Cost of the debt is also 0. Then like that. But definitely to just remain 14.6 because there is no debt. There is no debt for that level. We go to the next one. The next one, we continue with our working. So I said you leave how many lines? Are they 6? So now we are doing the workings. We go to the bond rating BB. We go to the bond rating BB. So that BB, debt to equity ratio. Debt to equity ratio, it is 0.25:1. So this one I had advised you, you just go to your calculator, you press 0.25, then press the answer, then press that sign of AB, then you divide by C. So it should be able to give you 1:4, like that, isn't it? Yeah, so we got that item. So that when you add them together, it will give you 5. So that debt should be 1/5. You remember this one was 0.2. So equity should be 4/5. This one was 0.8. That one was 0.8. So when it comes now to this point, the proportion for equity is 0.8. The proportion for the debt is 0.2. Like that. Then now at this point, 1.2, then 1 plus. So debt over equity, they have already calculated for you, 0.25. They have already computed for you, 0.25, also not by 0.7. 1.4. So it will give you a figure of 1.41. So you proceed to this point as 5, then we add 8, 1.4. Nakuja which figure? 16 points. So it also come at this point, whereby it should be 0.8 multiplied by 16.28. You also add 0.2. So pre-tax cost of the debt, they gave you 8.5. Also multiplied by 0.7. So that is now the second one. We now go to the third one. So the third one, it is PP, bond rating BB. So that bond rating BB, they gave us zero debt to equity. It is 0.9. So it is 0.61. So go to your calculator and see what you can get from there. So press 0.6 and get the answer. Then also press again AB divided by C and see to give you which value. It is giving us 3:2. So this total should be 8. So that debt will be 3/8. Equity should be 5/8. So I know they have decimal places, isn't it? So if they have decimal places, don't bother dividing. Have them like that. So that equity here, it will be 5/8. The debt will be 3/8. We just have them like that because they have decimal places. When they have decimal points, don't bother to divide. Just write them in full the way they are. Just write them the way they are. Just in case they have a lot of decimal points. So now we come to this area. It will be 1.2, also 1 plus. So D/E is already computed as 0.6, like that. Also multiply 0.7. Then you get the value for that. Inakuja which figure? 1.7. So get to this point 5, then also 8, also 1.7. So it should be able to give us 18.6. So this will be 18.6. So when it comes to this point, equity just take 5/8 multiplied by 18.6. Like that. You also add the one for the debt, it will be 3/8, also multiplied by pre-tax is given as what percent? 10, also multiply 0.7 to get the figure for that area. So we go to bond rating C. We go to the bond rating C. So debt to equity ratio, they gave you 1.7. 1.7:1. So what are you getting on your calculation? So, if I may ask, those who are in class, wananiambia hii figure, is it 1.7? Hiyo tumetoa hapo. Yeah, some people online that are telling me it is not that figure, it is. So those, because there's only 2 people who are getting, who have the past papers with different values. So maybe you confirm how they are presented. Me, I have the original one. So follow whatever I'm giving you. I have the original one. So follow whatever. So it is not 3.4. Is there anyone with 3.4 anyway? So we don't have those. Maybe the printing part on your side was not clear. When you are adjusting, there was a mix-up. But just get whatever I've given you. That is from the original paper. So it will be the same as 17:2. So 1, then 7, then dash 10, isn't it? Yeah, so that simply means that you multiply each one of them by 10. We multiply each one of them by 10. So it will be the same as 17 is to 10. So that the total will be 27. So that debt should be 17/27. Your equity should be 10/27, like that. So when it comes to this point, half 10 divided by 17, sorry, 27. Also, you can have 17 divided by 27, like that. So that it will now be 1.2, 1 plus. So this one is 1.7, also multiplied by 0.7. It is 2.63. So you get 2.63. So you also get to this 0.5 plus 8, then 2.63. 26.04. So that when it comes to this point, we just take 10 divided by 27 multiplied by 26.04. Then also 17 divided by 27. So pre-tax, you are given which figure? You are given 14, also 0.7. Then we should also check now the bond rating D. So bond rating D, they gave you debt to equity. It is 0 point, so it is 2 points. It is 2.5:1. So confirm that. It will be the same as which ratio? It is 5 to what? 5:2. You want to not bear? Sorry? 2:1:2. 2:1:2. So it is the same as 5:2. So it will be the same as 5:2. So when you add them, they will be giving us 7. So that will be 5/7. Equity will be 2/7. Like that. So this one is 2/7. Also 5/7. The 3.3. That's 1 point. So this one will be 2/7. That's 1.4. So you confirm where do the WSEC minimum? So check where the WSC is minimum. The second one. So I'm told it is along this portion. So we can now make a conclusion on that area. We can now make a conclusion from that. So there was Roman letter 1 and Roman letter 2. So we start with the Roman letter 1. So Roman letter 1, we know that the optimal capital structure, is where WSCC is minimum. Is where WSCC is minimum. Is where WSCC is minimum. I.e., where equity is 80%, where equity is 80% and debt is 20%, and debt is 20%. As you see, the 0.8 is the same as 80%, 0.2 is the same as 20%. Then now Roman letter 2, they were asking you the optimal WSCC. So Roman letter 2, the optimal WSCC. So Roman letter 2, what is that optimal WSCC? WSCC, it is 14 point what? Yeah, so you write there the optimal WSCC is 14.21. The optimal WSCC for the Roman letter 2, it is 14.21. It will be 14.21. So that is now in that area on how we can determine the optimal WSCC and also the optimal capital structure. When we started the theories of the capital structure, there were 2 questions. There were basically 3 questions where we were saying that whether the amount of the debt in the capital structure will affect the WSCC, and also whether amount of the debt in the capital structure will affect the value of the firm. Then in case the debt will affect the value and WSCC, then what was the optimal capital structure? Optimal capital structure is where the value is maximum, but WSCC is minimum. So far, we have been dealing with the WSCC. We shall also be getting questions where we use the value. For the value, you pick the maximum. So that's now the summary for that level. So let us have a brief subtopic still on the same as types of the capital structure theories. We can now have a subtopic as types of capital structure theories. We can now also have a subtopic as the types of the capital structure theories. Types of the capital structure theories. So under that, we start with number 1. We start with number 1. Number 1 will be net income theory. Number 1 will be the net income theory. Net income theory. So under that, we note that according to this theory, comma, the financial risk will not affect the individual cost of capital. Financial risk will not affect the individual cost of capital. It will not affect the individual cost of capital, i.e. leverage, So i.e. leverage will not affect the cost of debt and equity. Leverage will not affect the cost of debt and equity. Leverage will not affect the cost of debt and equity. However, the theory argues that, the cost of the debt will always be lower than the cost of equity. The cost of debt will always be lower than the cost of equity. Cost of the debt will always be lower than the cost of equity. Lower than the cost of equity because interest on the debt, is a tax allowable expense. Because interest on the debt is a tax allowable expense. Interest on the debt is a tax allowable expense. Then another paragraph, we note that the theory concluded that as leverage increases, WSEC will decrease. As leverage increase, WSEC will decrease. WSEC will decrease. This can be represented using a diagram as follows. This can be represented using a diagram as follows. It can be represented using a diagram as follows. So we want now to draw the diagram for that. So this one will be leverage. Then this side will be cost of capital. So we can now add there a paragraph that the theory concluded that there is optimal capital structure. There is optimal capital structure, there is optimal capital structure. There is optimal capital structure where WSEC is minimum, and the value of the company is maximum, where WSEC is minimum and the value of the company is maximum, and the value of the company is maximum. Hence, the capital structure decisions are relevant. Hence, the capital structure decisions are relevant. Hence, the capital structure decisions are relevant. The capital structure decisions are relevant. Then another paragraph, we note that according to this theory, comma, the value of equity, according to this theory, comma, the value of equity of the unlevered, the value of equity of the unlevered or ungeared firm, unlevered or ungeared firm will be expressed as follows. So we are saying that according to this theory, the value of equity of the unlevered or ungeared firm will be expressed as follows. It will be expressed as follows. So when you want to compute value of equity of the unlevered firm, so value of equity of the unlevered firm, it is supposed to be given by earnings before interest and the tax. Earnings before interest and the tax, then 1 minus the tax rate. Then we divide by KEU. So KEU is the cost of equity of unlevered firm. So when you want to compute value of equity of the unlevered firm, you simply take earnings before interest and tax, then in the brackets of 1 minus the tax rate, divide by the cost of equity of the unlevered firm. Cost of equity of the unlevered firm. So that now will be giving us the value of equity for the unlevered firm. Then also value of equity of the levered firm, it will be given by earnings before interest and tax. We subtract interest, then 1 minus the tax rate. We divide by KEL. So KEL is the cost of equity for the levered firm. KEL will be cost of equity for the levered firm. So you simply take earnings before interest and tax, you subtract interest, then 1 minus the tax rate, we divide by the cost of equity for the levered firm. So that's now how we shall be calculating the value for equity for the levered firm. So there is a small question in your past papers which I want us to use. There is a question for the sitting of June 2008, question 2 part A. Just check at the back of your past papers. There are some questions that were added there. They are not having a specific period. So I want you to check on check on page 93. Page 93, there is a structure there as June 208, question 2. Check on page 93. There is a small question there indicated as June 2008. There is a question number 2. So that question 2, number 2, it is reading that question 2 part A, where they said that, where they were able to say that the following extract of the balance sheet of Mapato Limited shows the capital structure of the company as at 31st December 2007. So ordinary share capital, the bar value was given as 125. Total amount is 62.5 million. Then they also gave you reserves. Then shareholders equity. Then long-term liability, you are given 14% debenture stock. The bar value is 500. Total amount is 118.5 million. So total is 302,500. The management of the company considers the above capital structure to be optimal. So additional information, note number 1. The company's earnings before interest and tax, it averaged how much? 75 million per annum. These earnings are expected to be maintained in the foreseeable future. Note number 2, ordinary shares of the, so that statement should read that the market price of the ordinary shares. Make a correction on that note number 2. It should read that the market price of the ordinary shares is 400 shillings per share. So remove that debenture aspect. So that sentence should read that the market price of the ordinary share is 400 shillings per share. It is 400 shillings per share. So they have written that the ordinary shares of the debenture is 400 per share. So that statement is not correct. The correct statement should be the market price of the ordinary share is 400 shillings per share. Then note number 3 is that the market price of the debenture is 525 per debenture. That one is correct. Then the corporate tax has been given as 30%. So required using the net income approach. Net income approach is the same as the net income theory, but now incorporating the tax, calculate the companies. Roman letter 1, it is cost of equity. Roman letter 2, after tax, cost of the debt. Then Roman letter 3, it is WSEC. So this company has equity and debt. It means it is what? Levered. It has both equity and debt. So Roman letter 1, they are asking me to calculate the cost of equity. So we use this formula here, but we make KEL to be the subject. They want you to get the cost of equity. The cost of equity and that company is levered. So we shall come at this point. We make this KEL to be the subject, which will be given by earnings before interest and tax. We subtract into, then we tax. Then we divide by the value of equity of that firm because it is levered. That company has both equity and debt. So that firm is levered. So that Roman letter 1, they want you to get the cost of equity. I will be using this formula number 2 because the firm is levered. The firm is levered. So that Roman letter 1, we get the cost of equity. Cost of equity. So cost of equity, because the firm is levered, it will be the same as KEL. The firm is levered, it will be the same as KEL. which will be given by earnings before interest and tax. We subtract interest, then 1 minus the tax rate. Then we divide by value of equity. Value of equity, which must be expressed as a percentage. The value of equity, which must be expressed as a percentage. So we start with market value of equity. We compute market value of equity. So to get the market value for equity, we get the number of the ordinary shares. Number of the ordinary shares multiplied by the current market price per share. Current market price per share. So to compute that market value for equity, simply come up with the number of the ordinary shares multiplied by the current market price per share. So number of the ordinary shares, you check through the capital structure. The total value for the ordinary shares is 62.5 million. The bar value per share is 125. So when you divide, that will give you the number of the ordinary shares. Then in the note number 2, we say that the market price per ordinary share is 400 shillings per share. So multiplied by 400 and see it will be able to give us which value. Unakuja which figure? 200. So it will give us 200 million. Then we also compute interest. So interest, are you able to see under the long-term liabilities? So long-term liabilities, you are given 14% debenture stock. The bar value is how much? 500. So the total figure is 118.5. So get 14% of the 118.5 million. We get 14% of the 118.5 million. Tunakuja which figure? 16.59. So now from those workings, we can be able to compute our KPL. So note 1, when you check in the note number 1, you are given earnings before interest and tax, where they gave us how much millions? So you take the 75 millions, subtract 16.59 millions. Then the question had given you the corporate tax in the note number 4 as 30%, which is the same as 0.3. Then now divide by the market value of equity, which is 200 million. Then express that figure as a percentage. Then express that value as a percentage. Inakuja which percent? Yeah, so that is now our Roman letter 1. So we now go to the Roman letter 2. So Roman letter 2, they were requiring you to compute. They were requiring you to compute what is supposed to be after tax cost of the debt, the market value weighted. So that will be the same as the cost of the debenture. So they simply want you to compute the cost of the debenture. So that debenture is irredeemable. They have not given you the maturity value. They have not given us the maturity value. They have not provided the maturity value. So we are computing the cost of the debenture. The cost of the debenture. So that debenture is irredeemable. They have not given the maturity period. When it is irredeemable, KD is supposed to be given by interest 1 minus the corporate tax. We divide by the current value for the debenture. We normally subtract the flotation cost. Then we express it as a percentage. So to compute the cost for the debt will be the same as the cost for the debenture. So we shall be calculating the interest per debenture. We also use the current market value per debenture. So interest will be calculated on the bar value. Interest will be computed on the bar value of that debenture. When you go to the capital structure, under the long-term liability, you have been given an interest of 14% debenture stock. Then in brackets, the bar value per debenture is how much? 500. So get 14%. Get 14% of 500. That will give you the interest per debenture. So it is giving us then current value for the debenture. You go to the note number 3. Note 3, they gave us the market price of the debenture is 525. So the question did not provide for the flotation cost. So now we can get our KT, which is going to be 70, then 1 minus 0.3. We divide by 525. The flotation cost is at 0. Then also express that value as a percentage. Also express that value as a percentage. Nakuja 9.3. So finally we go to the Roman letter 3. Roman letter 3 is the market weighted average cost of capital. Roman letter 3, they would like you to compute the WSEC. So we compute the WSEC. So WSEC, it will be given by weight of equity, cost of equity of the delivered firm, weight of the debt, KD, which must always be after the tax. KD, which must always be after the tax. So we get the total market value. They are saying we use market weighted value. So we come up with the total market value. So to get the total market value, we start with the equity. And the equity is simply the ordinary shares. We have already calculated. The market value for equity, you remember the 62.5 millions. You are able to divide by 125. Then we multiplied by, was it 400? Yeah, so when we multiply by 400, remember it gave us 200 millions. Then we now also do the same for the debentures. So for the debentures, we also take 118.5 millions divided by the bar value, which is 500, multiplied by the current market price, which was 525. So that we also come up with the value for that. Sorry? 124 points? Like that. So now you add them together. Wengine mnapata ngapi? 124.4 25. Like that. So total should be which figure? 3, then 425. Like that. So now we can compute our WSEC. So now our WSEC, the weight for equity, you take 200 millions, divide by 324.425 millions. So multiplied by KEL. KEL was the cost of equity for the Libert farm in the Roman letter 1. Our KEL in the Roman letter 1, it was giving us which figure? We got 20 points. 20.44. Then now we also add the weight for the debt. It is 124.425. Also divide by the total 324.425. So we calculated KD after the tax in the Roman letter 2. We got 9.33. Yeah. So it is already after tax. That figure was already after tax, so don't tax it again. The value was already after the tax. So that is now meant to be your Roman letter 3. How to get the WSEC. How you are to compute the WSEC. So given the time, we shall stop there. When we meet, we shall check one more question on that. So remember to remind me, it will be May 2019. May 2019, question 3, part B. So May 2019, question 3, part B. That's now what we shall do next. For now, we can stop there. When we meet, we shall do that question.